Assalamu alaikum, my dear students. I am Sadia Hussain, lecturer, Department of Finance and Banking. Today I am going to discuss Chapter 2, which is Sources of Finance. My dear students, today I am going to discuss Chapter 2, Sources of Finance. Finance means fund collection, its management and distribution. In this lesson, we will learn about the concept of sources of finance for doing the fund collection activity efficiently. Different sources of fund have different features. For these different features, funds should be collected from different sources suitable for different situations of the business. Sources of finance. To get the fund required for the purpose of starting any business or to conduct the daily activities of business, selection of the sources of finance is one of the important decisions in financial management. Besides, an institution collects funds by analyzing different sources to select that mixture of sources which will provide maximum benefit and minimum cost. Main objective of investment is earning profit. It is to be mentioned that when the total income of a business firm is higher than the total expenditure, it is generally called total profit. We can get net profit by subtracting the cost of capital and tax from total profit. So, the cost of capital should be reduced to maximize the profit of the business. Business finance means supplying of funds required for running a business. Due to the differences of forms, nature, and objectives of business, an organization collects funds from different sources. In every organization, there are two separate sources of finance. One is the owners and the other is the creditors. First one is internal sources. Funds provided by the owners are called internal sources of finance. Internal sources of finance can be categorized into two different types. One is ownership-based internal sources. These sources are also divided into two basic types. First one is owner's capital and second one is share. So, let's discuss ownership-based classifications of internal sources. Basically, nature of internal fund is different from different kinds of business organizations. We know that based on ownership, organizations may be of sole proprietorship, partnership, or joint stock company. In case of sole proprietorship business, sources of internal fund are owner's own savings, or it may be any kind of factors of production measurable in money such as land, labor, capital, and organization, which are used in production. If the organization is a partnership business, fund invested by the partners is considered as the owner's capital. On the contrary, if the organization is a company, fund collected through share selling is considered as internal source of finance. Joint stock companies are two types, public limited and private limited. Number of initiators in private limited company is 2 to 50 and in public limited company it is minimum 7 and the maximum number may be any number limited by the shares. Both public and private limited companies collect capital through share selling. But A private limited company sells shares among the specified owners instead of selling them in the share market. An important source of capital collection for a public limited company is share selling. Another segment of internal sources is profit-oriented internal sources. It can be basically categorized into two basic types: undistributed profit and savings fund, and second one is dividend equitable fund. So, what is profit-oriented internal sources of finance? A business institution earns money through producing goods and providing services. The money which remains left after deducting the production cost, selling expenses, etc., from these earnings is the profit of the business. The remaining portion of profit after deducting the interest of loan and the tax payable to the government can be used in various ways as a source of fund, and these are discussed here. First one is undistributed profit and savings fund. The portion of profit which is invested in the business instead of distributing among the shareholders is called undistributed profit. If this undistributed profit is kept in separate fund for the purpose of business expansion in future, it is called savings fund. Then, dividend equitable fund. Shareholders of a company usually get dividend from the company on a regular basis. Goodwill of the company implies with giving this dividend. If in any year business earns less amount of profit, payment of dividend is not possible, but inability of dividend payment may be deteriorate the business image in the market. So in the year when the business earns huge profit, the company keeps aside small portion from the net profit as dividend equitable fund, which can be used to pay the dividend also in the year when business earns insufficient profit. By this way, fund gives the business ability to pay dividend on regular basis. External sources of fund. External fund means external sources from which fund can be collected, such as fund collected from external sources. For example, a loan from bank. External sources of financing are very popular. There are two reasons of this popularity. First one is, if business is financed externally through loan, tax is imposed on the profit left after deducting the interest of loan. Thus, less amount of tax can be paid. Second one is, in the case of small business, many times internal financing becomes comparatively less in amount. As a result, external sources act as the main sources of finance. On the basis of terms, external can be divided into three basic categories: short-term, mid-term, and long-term. Short-term means less than 1 year. Most of the finances of an organization are usually collected from short-term sources, which are repaid within a year. There are some examples like discounting bills receivable, bill payable, short-term bank loan, bank overdraft, etc. Mid-term financing. This type of loan extends for 1 to less than 5 years. A business firm uses this fund to meet the demand of long-term needs of the current capital. Cost of capital or interest rate of this fund is higher than that of short-term sources of finance and less than that of long-term sources of finance. Last one is long-term financing. Long-term financing extends from 5 years to the maximum of any duration. Long-term financing has some distinctive features. First one is long-term finance is the amount is bigger than the mid or short-term funds. So this fund is usually used to acquire fixed assets like land, building, equipment, etc. Then another feature is related with the repayment schedule. If long-term fund is collected through loan, it is easy to repay as per contracted payment schedule. Again, if long-term fund is collected through selling shares, then this fund is considered as owner's capital. So this liability need not be repaid till the business dissolution. My dear students, that's all for today's class. If you have any kind of questions or queries, you can call me or we can discuss it in our Zoom class. Allah Hafiz.